Hey, this is Chris from Stockspot, and it's that time of the year again, end of financial year, when investors look at their investments and decide what they should be buying and selling for tax purposes. And this year, one of the big trends that we're seeing in the market is that people are selling pizza. And I'm not talking about Hawaiian pizza or Meat Lovers pizza. People are selling Domino's pizza shares because they've been one of the worst performers on the ASX this year. They're down about 26% since their profit downgrade at the start of the year, and therefore, for a lot of people, they're underwater on their investments, and they're looking at Domino's Pizza as a potential tax loss sale. As well as Domino's Pizza, one of the other big areas of the market that there's likely to be tax loss selling in is in lithium stocks. Stocks like Mineral Resources, IGO Limited, Pilbara Minerals and Liontown Resources have been some of the dogs of the market this year, down between 10 and 60%. And so people are trimming those positions in June as well. What is tax loss selling? Well, tax loss selling is really the idea that at the end of the tax year, usually around June, people look at their portfolios and are trying to offset any gains that they've realized during the year with some losses, because really you pay tax on the difference between the two. And so you can reduce your tax by actually crystallizing some losses as well as crystallizing some gains. And so often what you see is that stocks that have already done badly during the year accentuate those losses in June, because there's even more selling pressure, because people who have lost money want to actually lock in those losses. And then typically in July, you see a bit of a reversal where those stocks that have been sold off a lot in June have a bit of a bounce because all of that selling has been exhausted. So what's the alternative to tax loss selling? Well, I guess the big opportunity people have, rather than tax loss selling individual stocks, is actually to avoid that altogether by owning ETFs. ETFs, rather than owning individual stocks, actually own the whole market. So first of all, you're less likely to have losers each year, but also ETFs are automatically rebalancing within the ETF. So you don't need to worry about any of the rebalancing yourself. The ETF automatically does it for you. And then if you use a robo-advisor like Stockspot on top of those ETFs, we're actually rebalancing your overall portfolio at the same time. So if you are in that position this year where you're looking at your portfolio and thinking about trimming holdings, it may be a time to consider overall, should you be investing in individual shares at all? Is it worth the time and effort and the hassle of having to do this tax loss selling every year? If the answer to that is no, it may be time to consider other investments that really don't require this sort of effort to tax loss sell every year. ETFs, I think, are a great option that really reduce the need for tax loss selling, and a automated investing service like ours might be a way of having access to these in a simple and easy way. And if you do want to find out which portfolio we would recommend for you based on your circumstances, the best way to do that is coming to our Stockspot website, answering a few questions, and then we will recommend the right strategy for your time horizon and goals, a strategy that best suits what you're looking to achieve.